Morning, Market Chameleons. 9 a.m. on Friday morning. D, you ready?
Good morning, Will. How are you?
Great. Let's get started with the disclaimer. What do you think?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, contact your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
Excellent. I hear there's rumors of you showing us a new tool this morning.
Yeah, so we did push out a new tool yesterday with the fair value model for equities. So I'm going to start going over that today. And this will be kind of our second version. And as we move on, that this will improve. But I'm going to kind of go over it today and just go through an explanation how it works. So before we do that, let's just start out with the pre-market report, and then I'm going to move on to that fair value calculation. Okay.
Excellent.
So these are stocks that are trading in a pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm going to quickly take a look at what's going on in the higher market cap stocks. So I'm going to use this filter market cap, stocks 20 billion market cap or higher. We'll see. So we see here today in a pre-market, 13 made the percentage gainers list, 77 on a percentage decliners list. Couple of them that I think we'll talk about as we go over the new tool is I'm seeing Tesla there. So I think I'm going to use Tesla as an example. DocuSign, that reported earnings. So maybe we'll take a look at DocuSign as well, because we talked about that yesterday pre-earnings. Nothing is sticking out too much at me right now. There's some pre-market movers here, not a great amount of volume. Looks like CPNG made the top of the list, up 6.6%, and that's trading almost 1 million shares in the pre-market. I'm not seeing any headline news right now for that move. But besides that, everything else looks kind of tame. I'm going to take a look at the report that's unfiltered. We do have a couple that are moving in a pre-market hours that are making top of our list, but lower market cap stocks. So NLSP up 100% on 9.3 million shares. That's a $33 million market cap stock. Looks like it's in the healthcare space. There is some news out there. I'm just hovering over just to let you see what the headlines are. ENTX, the second one on the list, up 51% on 11.5 million shares. That's an $85 million market cap stock. So taking a look there, that could be, I don't actually see this, just an announcement that they're going to be reporting earnings March 18th. So if there are no questions on a pre-market report, will today, to save time and give more attention to that fair value calculator, I'm going to move on.
Great.
All right. So I think the first one, what I'll do to demonstrate it is I'm going to go to, let's use Microsoft. It's easier to do it with a more established company. So I'll start out with Microsoft, and I think then we'll take a look at a couple other ones like Tesla, DocuSign. If you have any other symbols that are popping up as I'm going through this, will just let me know. I'll take a look at those symbols. So in this calculation, I'm going to go to the fair value. It's under fundamentals, fair value. And what this attempts to do is take a look at, well, here's the stock price. What do we think the fair value is according to its historical valuations? And then we're going to take a look at what we think it is according to forward estimates. Okay, so you got two models here. This is the historical, and then this is going to be using forward-looking calculations. So let's just take a look first at the historicals, what this is doing. And to get a sense of where we think that the the stock should be priced based on where it has been historically, we'll take a look at these two metrics here. So we see that the 3-year average P ratio, Microsoft's is 38.6. So if we use that as our benchmark, this is where the price of Microsoft approximately would be. If we use the price to sales ratio, which is basically taking its market cap, dividing it by its revenue, trailing 12 months revenue, this is where the 3-year average is. So if we use that as our benchmark, this is the implied value of Microsoft. We also do the same thing, comparing it in relationship to the rest of the market, like SPY. So we see here that Microsoft's current PE versus SPY's current PE, it's at a 7% discount. Historically, the 3-year average is at a 45% premium. So if we use that as our benchmark, this is where Microsoft's implied value is. And then we do the same thing, price to sales ratio. So price to sales ratio for Microsoft versus SPY, 308% premium. 3-year average, 266% premium. You know, if we use that as our benchmark, that's the implied value. We take the average of these, that's 255 over here. So we see it looks like a 7% discount to that average. So probably fairly, you know, almost fairly priced, not a huge discount or premium there. Now that's using the 3-year historical, but a lot of times, right, or probably most of the time, the markets are forward looking. They're saying, okay, this is how they were priced versus each other historically, but how are we looking going forward, you know, given the growth rate, expected growth rate and profit margins. Okay, so that's what we're going to be doing going forward, seeing how is Microsoft being priced versus the rest of the market. So I'm going to move on here. If there are any questions on what I just did, Will, let me know. If not, I'm moving. Okay. So this is the new model, and let me now go through it because there are more components in it. So let me try to explain to you before we go through the components. And this is the calculator over here. So you got different inputs for Microsoft, and then our benchmark is SPY. Okay, so that's what we're using as our benchmark. Now, when we're running the model, why do we use the benchmark? So the benchmark really kind of sets the where we think things should be priced relative to all where the market is pricing all the other relative assets, right? Because that's what you're really pricing against, all the other relative assets. So think of it kind of like this. If you're out in the market buying a car, right? Like say two-year-old car, and it should you be paying 30,000, 20,000? Like where should it be priced at? So you might take a look at the market on average. Where did a similar car that's 2 years old, sell for? So if you have an average price of let's say 20,000, then approximately 22,000 is higher than the average, 18,000 is lower than the average, and is that justified? Okay, so that's why we're using an overall benchmark to compare how does Microsoft compare to the overall benchmark. And the idea is this, that if Microsoft is a worse deal than the SPY, right? If it's a worse deal, then really why should you be invested in it? You have to justify it because you're better off in the benchmark. It's more diversified, less volatility in the earnings. So to get out of SPY, there has to be a reason, right? Otherwise, you're just hanging out in SPY. So if you're leaving the benchmark, there has to be a reason for it because you think you're going to make outsized returns, right, relative to SPY. And I'm going to use Microsoft right now. It's a little bit more established, and then we're going to take a look at growth stocks, how people are pricing in growth stocks like Tesla and maybe DocuSign. So far, everything makes sense?
Yeah. No.
Okay.
Anyone have any? It's a little bit of a delay. We run about 30-second delay. So if you have any questions about the new calculator, which this is the first time I'm seeing it. It's very cool, D. Thanks so much for getting that to the Chameleon community. Guys, any questions, please ask. Or if there's stocks you want Dimitri to run through the calculator, let us know. Yep, all's good, D. They're coming through, all good.
Okay. All right. So here's how we're setting this up. First thing we want to know is in the next 5 years. So we're going to compare going forward in the next 5 years. We don't know for sure, so we got to make assumptions, right? Reasonable assumptions. So in the next 5 years, first we want to think, what do we think Microsoft's operating margins will be versus SPY's operating margins? Now, by default, we're just using, here you have reference points, historicals. So this is Microsoft's current operating margin, 37, versus SPY, 11.5, right? So we see Microsoft's operating margin is bigger, but we're going to equalize that, and you'll see what I mean. But and we see the history. Now, if you think it should be different, you could change it here. Why are we using operating margins? So operating margins are your profit margins. So for every dollar in sales from your core business, how much profit are you getting? Okay, so it's based on your core business, not your total margins, but your core business. Now, why is that important? For example, if I'm buying Tesla, if I buy Tesla, the entire company, really what I'm interested in is how much profit is the core business making. I'm not really interested how much profit did he make off Bitcoin, right? Because I could do that myself. If I'm buying the company, how much profit is the company actually making, right? Because other investments or ventures, whatever, those are different. That's not part of its core business. So we're going to take a look at operating margins. If I'm buying this company, I want to know, and I sell off all, whatever investments they have, like Bitcoin or whatever, what am I going to be making? All right. That's what we're looking at. So using the operating margins, we're going to say if Microsoft continues on the same path as its current operating margins, 37, and we could change that. You could manually change it, or you could click on one of these, 5-year average, 3-year average. But let's just leave it for today's purposes. Let's leave it right now on the current one, and I'll show you how to change that on other ones. But we'll leave it on the current one, and we're going to assume for next 5 years, that's where Microsoft approximately their operating profit margins 37%. SPY, this is its current one, 11.5%. We're going to leave that there as well. Okay, so we see here, okay, Microsoft is doing better operating margins than SPY. So what is our calculator going to tell us? Revenue growth. So besides operating margins, how much do we think their revenue is going to grow, right? Because you're getting, the higher your revenue goes, the more profit margin you're going to have in aggregate, right? Because it's 37% of every dollar you make. The more dollars you make, the more profit you have. So if you have your revenue at X amount today and it grows by 10% per year, every year you're making more and more profit, even keeping the same operating margin. So how much do we think Microsoft's revenue is going to grow versus SPY? So here it's defaulted to a 3-year average. Okay, so in the 3-year average, Microsoft, it's 17%, SPY 4.3. Again, we could change these assumptions, but for now, let's just keep it at the default for this demonstration. So far, we got 2 inputs in our calculator to generate a return. So we got operating margin, very important, and revenue growth. The other thing that we want to see, and this will kick in, is comparing the volatility. So for example, let's say I have 2 same exact houses, right? I bought one house for 100,000 and another house for 100,000, and they both make the same amount of rent, $10,000 a year, $10,000 a year. Well, that seems equivalent, right? Because I'm getting 10% on house A, I'm getting 10% return on house B. But let's say one is more riskier. Let's say house A we think our downside is 5%, right? That if something happens historically, the market goes down, it's down 5%. But house B is less liquid, and in the same period, that house was down as much as 10%, right? So house B is a little bit more riskier than house A. So for the same return, for 10% return on house A, I'm risking 5%. For the same return in house B, 10%, I'm risking 10% of potential loss. So for every percentage in risk in house B, I'm getting less money than for every percentage risk in house A. Does that make sense to everybody? If not, let me know. But what we did was we took, we're estimating operating margins, revenue growth, and the volatility we're using as the potential risk. Okay? And you could change these assumptions. So that's how, so then we hit calculate, and here's what it says, that based on these inputs, based on all these inputs, we think the implied value of Microsoft is 283 versus market price 237. That's a 16% discount. And if we want to do, that's without risk adjusted. If we want to do a risk adjusted, we think it's worth 211. Microsoft's 237. That's 12% premium. So let's take a look at those inputs.
AD, we had a question about the availability of the calculator and the fair value. Was that pushed out today, or is that still internal?
Yeah, no, that was pushed out last night.
All right, Mike H. So that should be available. Mike H. just joined. Can you just let him know again where you?
So when you go to a symbol and you go under fundamentals, it's fair value, and you got two calculators here. We have one using just historical multiples. This one, we're using forward estimates, okay? So I'm approximate right now for forward estimates. I'm using the historical reference points to say that, you know, given this information, if these numbers persist in the next 5 years, where should Microsoft be priced? Okay, and then we're going to do some examples where I'm going to be changing those inputs based on more data and information. But in this example, I'm just going to use the historical, you know, because they look, you know, relatively, they're not very volatile. I'm going to use the historicals to say, like, if this persists in the next 5 years, where should Microsoft be priced versus the rest of the, based on where the rest of the market is priced. So let's take a look how this looks. So look, we have operating margin 37 for Microsoft, SPY 11.5%, revenue growth 17% for Microsoft, SPY 4.3%. So what does that look like? Here are the calculation results. So SPY market cap 36.4 trillion, Microsoft market cap 1.8 trillion, trailing 12 months revenue 12.1 trillion in SPY, Microsoft 153.3 billion. Okay, we're comparing this. So having said this, right, the idea is, if I buy SPY, all the companies in SPY, right, it's going to cost me right now 36.4 trillion. I own them. In 5 years, how much operating profit am I going to get? If I buy Microsoft, you know, if I buy all the stock in Microsoft, it's going to cost me $1.8 trillion. In 5 years, how much operating profit am I going to have? And which one is a better return? Right? That's the question. Which one's going to be a better return on my money? So let's start out here. This is SPY. Remember, we assigned it a 4.3% per year revenue growth. So if we start out at 12.1, in 1 year, the revenue would grow to 12.7. Then it grows another 4.3%. It goes to 13.2. Remember, annual growth rate, 13.8, 14.4, 15.2. So you could see here every year it's going up, you know, by 4.3%. Operating profit would be, we have it set at 11.5%. So out of our revenue, whatever revenue is generated, 11.5%, that's going to be our profit. right? So 1.5 trillion year one, 1.5 trillion year two, 1.6 trillion, 3, 4. So at the end of 5 years, we're remember, these are estimates. I don't know, we don't know for sure. I'm just using a calculator. There's no guarantee here. I'm just using estimates. I just
and like anything,
we don't know it.
Market slows down, economy,
Right. I'm just
earns.
using at the moment the best information I have. How do I, right? Because I don't know what's going to happen next year or 2 years. Just at the very current moment, how do I think they line up? Right. That's the best I could do. So 7.9 trillion in SPY. So if I bought all the stock for 36.4 trillion, and in 5 years I got 7.9 trillion, my 5-year return would be 21.8%. Okay, that's the return on the market cap, the return on my money if I bought it outright. What about Microsoft? So Microsoft, we had 17% year over year growth and a 37% profit. So you could see here, if we started here, next year, we think the revenue will be 179.3 billion, year two, 209.8, year three. So you could see, we're giving it a growth at the end of, and then out of the revenue, how much of that do we keep in profit? Well, if there's a 37% profit margin, year one, 66.4 billion, year two, 76.6, year three, 90.8, and so on. At the end of 5 years, we got 465.5 billion. Okay, so we got 465.5 billion, but we bought the company for 1.8 trillion. That's today's market cap. So if we bought it for 1.8 trillion and in 5 years we got 465.5 billion, we made a 26% return. So that's actually better than SPY, right? So we got compensated for leaving, theoretically, we got compensated for leaving SPY to get more return. That means to equate them, and here's what it looks like here, right? 26% profit in 5 years in Microsoft, 21% in SPY. So we got compensated for leaving SPY to go into Microsoft. Do we get compensated enough? Well, the question is, there's more volatility in SPY, right? I'm sorry, in Microsoft. So Microsoft's 33 versus SPY 24.8. So if we divided that up, this is our total return by the volatility, total return by the volatility. You can see here, this is volatility. Microsoft is higher than SPY. So if we divided the return by the risk, SPY is a little bit better. So here, on a non-risk adjusted basis, Microsoft's at a 16% discount, right? Because to get the same returns as the market, Microsoft implied value is 283. Right now, you could buy 237, so you're getting it at a discount, a theoretical discount. If I adjusted for the risk, it's 211 versus 237, so 12% premium. Again, these are approximations, so they're not it's probably around fair value, right? It's not exact. We're not talking about exact sciences here. We're talking about approximations. So it's probably in line, close to fair value when we're talking about these numbers, because you're going to have volatility in there as well. Does that make sense in what I just did in Microsoft? If there's any questions, well, let me know. I'll just go back over it. If not, I'll start going to other.
Yeah, actually, we had a request for 2 symbols from 2 of the chameleons. I think I don't know if it was Mike. Someone was asking for NVIDIA, NVDA. Okay. The other was asking for Boeing, BA. If we can't get to both of them today, we could do one on Monday. So
yeah, I'll leave them. I'm going to do really quickly Tesla and DocuSign, and then I'm going to try to get to them. So I'm going to go quicker on it, but let's just take a look at Tesla, because why, because this this is in Tesla. How are people pricing in growth? You know, because you have people who are very adamant about Tesla's growth rate and saying, well, it's being underpriced because it's not compensating for the growth. So here's in Tesla, this is based on the historical valuation. So we see it's up there, 218% if we use the average P's and price to sales. I'm going to jump to the forward-looking ones. So here's what's going on in Tesla. Right now, if we just use its historical margins and historical growth rate versus SPYs, you know, and we say that persists going forward, using their historicals, if that persists going forward, it's at a 416% premium. So what are the people, let's take a look what we're using here. Tesla, we're saying operating margins are 6%. That's the most current. Now, the people who are fans of Tesla are saying those are way underpriced. Those operating margins, they're going up, and we see they are going up, you know, from five-year, 3-year current. They're saying you got to give it a 20% operating margin. That's what they're saying, right? So let's just do what the people who are big proponents of Tesla, what are they seeing? What are they telling us? 20% operating margins. Revenue growth, you know, again, you listen to the hedge funds and, you know, big Kathy Woods, they're saying year over year, they think the revenue is going to grow 80% for next 5 years. That's what, you know, that's what the people who are like big proponents of Tesla are saying, that it's underpriced because we're not giving it to them. We're not giving them the 80% revenue growth. We're not giving them the true operating margin. So I don't see 80% growth anywhere here on a 5-year average, 3-year or 1 year, but just for the demonstration, let's give it 80%, right? So we're going to say Tesla's going to grow revenue 80% year over year for next 5 years, and they're going to be able to achieve operating margins of 20%. Okay, so this is where we are now. If what they say is true, I'm going to recalculate it. All right, then this is what they think it should be worth, $1,200. All right, again, you're giving this to them now, right? Because we don't see these numbers. They haven't achieved it yet. We're just kind of giving it to them that, yes, you know, they're going to grow much faster than we've seen, you know, maybe because of, you know, growth in China or whatever they're projecting, you know, getting into the utilities business. They're projecting 80% growth, 20% operating margins. So that's what they're looking at if those forward expectations come to fruition. Does that make sense to people? So what do I see in the calculation results? Here's SPY, here's Tesla. If we give them 80% growth, 20% margin, this is what they would be expecting to make per year. We're looking at a 37.8% return versus SPY 21.8. So if we said how far away is that from the market risk, that's where the implied value would be. Risk adjusted, not so good. It's very volatile. Is that
so the risk adjusted means the volatility in the stock? You put that,
yeah, that there could be, right, because on the downside, right, the market, the stock could go down much faster than the SPYs, right? So you still have volatility risk, because what if things go wrong?
Yeah.
You know, what if
we
saw
what happened, right? Because it was priced almost, it was right around 1,000, right? So it was within 20% of, you know, what they were saying with the best projections. And right, you see where it is, you know, it got all the way back, you know, it lost basically half of its value in a very short period of time.
It's a very short period. Yeah. What we saw just in the recent down, right? Just in the recent sell-off, you know,
yeah,
you know, it was down, you know, from this price, $150. So there's more risk there, you know, so that's on a risk adjust, you know, SPY didn't fall 30% off its high, you know, like Tesla did. So that's on a risk adjusted basis. If you take out the risk, you know, and just say equal risk, that's the discount. So again, I'll be improving this model. This is the first version to start, you know, playing around. And of course, these are all estimates. Don't rely on these because we don't know for sure what's going to happen next year, 2 years, or 5 years from now. We're just using what we think the best information is to try to get an approximation.
All right. Well, that's the opening bell, D. We can get NVIDIA and Boeing to the
I'll do
comedians
NVIDIA,
on Monday.
Boeing. Monday, yeah, I'll also do DocuSign on Monday. So we'll start with that. I wanted to just kind of go through the explanation first, so people have an idea what's going on.
Excellent. So join us on Monday's show, everyone. D, have a great weekend. Thanks so much, buddy. Let's get ready to trade.
Thanks, everyone. Have a great weekend. Stay safe. Hope to see you guys Monday.